You make the final payment. No fireworks, no parade, just a quiet confirmation screen and a number that drops to zero. And suddenly, the thing you've been chasing for years disappears. No more mortgage, which sounds like freedom. But here's the uncomfortable part no one tells you. The moment your house is paid off, your financial life actually gets more complicated. Because now you have a new problem. What do you do with the money that used to disappear every month? Let's say you were paying $1,500 a month. That's $18,000 a year, every year, for maybe 20 or 30 years. Now it's just sitting there, waiting for a decision, and decisions with money are rarely neutral. They either quietly build your future or quietly erode it. So what actually happens after the mortgage is gone? First, the emotional shift. For years, your mortgage acted like a forced investment. You didn't have to think. You just paid. Every month. No debate. Part of that payment built equity. Slowly, predictably. You were, whether you liked it or not, accumulating wealth. Now that structure is gone. And here's the irony. Most people don't replace it. They don't recreate that forced discipline. They just absorb the extra cash into their lifestyle. Better dinners. More travel. Upgraded everything. Nothing dramatic, nothing reckless, just small upgrades that quietly consume that $1,500 until one day, it's gone. Not invested, not compounding, just spent. This is where the system changes, because when you had a mortgage, the system was simple. You traded cash for ownership. Now you're in a different game entirely. You're deciding how to allocate capital, and that's harder, because now every option competes with everything else. Invest it? Where? Stocks? Bonds? Real estate again? Pay off other debts? Maybe you still have some. Save it? At what return? Spend it? On what, exactly? There's no default path anymore, and that's where most people stall. So let's break down what's actually happening under the surface. When you had a mortgage, your return was hidden. If your interest rate was, say, 4%, paying it off early was effectively a guaranteed 4% return. No volatility, no risk, just steady progress. But now that the mortgage is gone, that guaranteed return disappears. Your money has no built-in destination. So the real question becomes, can you replace that 4% with something better? This is where things get uncomfortable, because the obvious answer is invest it. But investing is not the same as paying down debt. Debt repayment is certainty. Investing is probability. And probability comes with variance. Some years you're up 10%. Some years you're down 20%. Emotionally, those swings matter more than people expect, especially when the money used to feel safe and structured. So people hesitate. They wait. They leave the money in cash. And cash quietly loses value, not dramatically, not visibly, but consistently. If inflation is 3% to 5%, your untouched cash is shrinking every year, so doing nothing is actually a decision, and it has a cost. Well, now let's talk about the popular advice. Just invest the difference. Sounds simple. But here's the hidden mechanism. Consistency matters more than timing. That $1,500 per month only works if it's deployed regularly. Miss a few months, delay decisions, hesitate during market dips, and the compounding engine weakens. Because compounding doesn't care about intentions. It only responds to actual dollars invested over time. And this is where the structure of a mortgage was secretly powerful. It removed choice. Now you have to recreate that discipline manually. And most people underestimate how hard that is. So what are the real options? Option 1, rebuild the system. Treat that $1,500 like the mortgage never disappeared. Automate it. Invest it monthly into diversified assets. And no debate, no emotion. You've essentially replaced your mortgage with an investment engine. Same behavior, different outcome. Option 2, accelerate other goals. Maybe you still have higher interest debt, credit cards, personal loans. Paying those off is often a better return than investing because a 15% interest rate is hard to beat in the market. Option 3, increase liquidity. For years, your money was locked in your house. Now you can build cash reserves, emergency funds, opportunity funds. This adds flexibility, something homeowners often lack. Option 4, lifestyle expansion. The most tempting option, and the most dangerous, because it feels harmless. You earned this, right? But lifestyle upgrades have a unique property. They're easy to start and hard to reverse. Once your expenses rise, they rarely go back down, so that temporary reward becomes permanent overhead, and suddenly, your financial freedom shrinks again. Now here's where things get even more interesting. Owning your home outright doesn't mean you're done paying for it. Property taxes, maintenance, insurance, these don't go away. In fact, they often increase over time. So while your mortgage is gone, your housing cost is not zero. It's just less predictable. A new roof, a broken system, unexpected repairs. These can quietly absorb chunks of that freed up cash, which means your extra $1,500 isn't always fully available. Another subtle shift people miss. Now let's zoom out. Why does this moment matter so much right now? Because we're in a world where financial systems are less predictable. Interest rates move, markets fluctuate, costs rise faster than expected. The old linear path, job, mortgage, payoff, retire, doesn't behave the same way anymore. Paying off your house used to feel like the finish line. Now it's more like a transition point, from passive accumulation to active decision making. And that shift exposes something most people aren't prepared for. Having money is one skill, managing it is another. So here's the real contrast. The hype says, once your house is paid off, you're free. The reality is, you're responsible for every dollar, every decision, every missed opportunity. There's no bank forcing discipline anymore, no fixed structure, just you. And a monthly cash flow that can either compound quietly or disappear quietly. And the difference between those two outcomes is rarely dramatic. It's small decisions, repeated, month after month, year after year. So you paid off your house. The biggest liability is gone. But now, a different question takes its place. Not louder, not obvious, but more important than anything that came before. What system are you going to build to replace the one you just removed? Because here's the part most people don't expect. When the mortgage ends, time becomes visible again. Before, your timeline was built in. 15 years, 20, 30, a clear arc. Now there's no clock, just open space. And open space in finance is dangerous because it invites delay. I'll start investing next month. I'll figure it out later. I'll wait for a better opportunity. Months pass, then years, and the math quietly shifts against you. Let's run it. If you invest that $1,500 monthly at a 7% return, in 10 years, that's roughly $260,000. In 20 years, about $780,000. In 30 years, over $1.8 million. Same money, same monthly amount. The only difference is time. Now flip it. Delay investing for just 5 years. That 30-year number doesn't drop a little. It collapses because compounding isn't linear. It's backloaded. Most of the growth happens in the later years, which only exist if you start early enough. So the real risk after paying off your house isn't overspending. It's hesitation. It's losing momentum. Because your mortgage was doing something quietly powerful. It kept you in motion. Now that motion is optional, and optional things often don't happen. There's also a psychological shift that's harder to see. When you had a mortgage, your net worth was tied to something tangible. A house, a physical asset. You could see it, touch it. It felt real. Now, if you start investing, your wealth becomes abstract, numbers on a screen, and that changes behavior because people trust what they can see. They trust property. They're more skeptical of markets. So even if investing makes mathematical sense, emotionally, it feels less secure, which creates friction, and friction slows decisions. That's why some people, even after paying off their homes, go right back into real estate. And not always because it's the best return, but because it feels familiar. Leverage, property, rent, a system they understand. But this introduces another layer of risk: concentration. If most of your wealth is already tied to one property, buying more of the same thing doesn't diversify your risk. It amplifies it. One market, one asset class, one direction. If it works well. If it doesn't, everything moves together. So now the question isn't just where should the money go? It becomes what kind of risk are you actually taking? Because after the mortgage is gone, risk doesn't disappear. It just changes form, from debt risk to decision risk. And decision risk is harder to measure. There's no interest rate attached to it, no monthly statement reminding you, just outcomes that show up years later. Now let's address something people rarely say out loud. For some, paying off the house too early wasn't the optimal move, financially. If your mortgage rate was low, say 3% or 4%, and markets historically return higher than that, then mathematically, investing instead of accelerating payments could have created more wealth. But that's the clean spreadsheet version. The real world is messier, because peace of mind has value. Eliminating debt reduces stress. It simplifies life. And for many people, that trade-off is worth it. But once the decision is made, once the house is paid off, you don't get to stay in that emotional space forever. You still have to deal with the financial reality that follows. And that reality is this: you now control a stream of capital every month for the rest of your working life, and maybe beyond. Handled well, it compounds into something significant. Handled casually, it dissolves, quietly. No alarms, no warnings, just a future that looks smaller than it could have been. So the real shift isn't about the house. It's about identity. You're no longer just someone paying down a liability. You're someone allocating capital. And capital allocation is what determines long-term wealth. Not income, not even assets, decisions, repeated over time. Which brings us back to the uncomfortable truth we started with. Paying off your house doesn't simplify your financial life. It removes the training wheels. And what's left is a system you have to design yourself. No defaults, no automatic path, just choices. So the question isn't whether paying off your house was a good move. That decision is already behind you. The real question is quieter, more subtle, and a lot more important. Now that no one is forcing you to build wealth, will you?